Good afternoon, good evening, LFA, Lifetime Financial, and our trusted clients and longtime partners. Thank you so much for joining us in our first webinar of 2023. This is our 8th edition. It's kind of crazy that we've already done 8 webinars, but very thrilled to bring some timely updates within the capital markets and the investment environment as we step forward into 2023. We all know how much of a challenge we experienced in 2022, which proved to be an extremely challenging investment environment for the diversified portfolio. We had record and sticky inflation, which gave way to the need to cool the economy and rise interest rates at a pace we haven't seen since the 1980s. That brought an incredible amount of change into the marketplace and has set up a very interesting environment for 2023 as we navigate over this year and beyond. So we're thrilled to have you all joining us. On behalf of our entire team, we're just thrilled for the content that will be shared today, and really thankful for our partners at iCapital who are joining us to present some very timely information. I'm going to turn it over to Steve, and before I do, for those of you who have joined us before, we'll have a question and answer session at the end of the call. So if you have some questions, go ahead and save them for the end. There's a raise hand button at the bottom of your screen within Zoom. So go ahead and raise your hand if you have a question at the end. I'll help moderate the Q&A sessions. We'll go ahead and unmute your line so you can ask your question directly, and hopefully it should be a very engaging experience at the end. So with that, thank you for joining us, and Steve, I'll pass it over to you.
Oh my goodness, well, happy belated New Year, and it's February already. So this is our first educational webinar for the year, and this is our 3rd year of doing this, so we're excited to bring timely content and hopefully informational things we can use. But as Luke said, this is a partnership, and we have a very special and unique partnership with all of our clients, and we value that greatly. Also, kind of behind the scenes, we have a lot of investment partners, strategists, investment gurus that help us put together portfolios that are durable and long-lasting, and we believe are adequately diversified to deal with all the uncertainties that we deal with on a daily basis. But last year was probably one of the most difficult years, the most challenging for any portfolio manager. What was up was down, down was up. And so Anastasia is going to help us unsort this and help clarify things. So one of our investment partners is iCapital. They are a alternative investment company. And as you all know, we do a lot of market link notes. And one of our dear partners is McKinsey, who we spend a lot of time with our portfolio construction. And I just value this relationship in bringing us great content and great offerings. So McKinsey's going to introduce our speaker today, and really thank you for joining us. And I think you'll enjoy this.
Thank you very much, Steve. And yeah, I just want to say, I've worked with Steve and Luke for a long time, and sometimes we spend hours and hours working on finding the best structured product solutions for you all. But my job here today is a little easier. I'm just going to introduce you all to Anastasia Amoroso, if you aren't familiar with her already. So she's our Chief Investment Strategist at iCapital. A lot of you may recognize her from her appearances on CNBC and Bloomberg, and she's frequently quoted in financial news. Prior to her role at iCapital, she was the Global Market Strategist on the JP Morgan Fund's Global Market Insight Strategy team. And I just want to say, from everyone in my department, that we're very lucky as an organization to be able to meet with Anastasia weekly or bi-weekly to go over market trends, which in turn really influences a lot of the products we bring to the marketplace. So it goes without saying that, me and our team are really excited that you get to experience your expertise firsthand today. And I'll just, let her take it away from there.
Great. Thanks, Mackenzie. And thank you, Luke and Steve and David, for a kind introduction and welcoming me to the event. And thank you, everyone, for joining. It's great to be here. It's 3 o'clock on the West Coast. As you can tell, it is not 3 o'clock where I am. I'm in New York. And it's probably not the same nice weather as you guys have over there. But anyway, but it's great to be here with you. So I want to spend the next 20 minutes or so just sharing with you some big market thoughts and, how we think about the market outlook for this year. And also with kind of towards the end, share with you some of our top ideas for this year as well. And then would love to pick up on anything that you're curious about and would like to ask a question about. So the title of my presentation, as I think of it, should actually be, yes, there's a luxury of being both opportunistic and defensive, but the title really should sort of be silver linings, because that's what the markets have been recently feeling and acting upon, is that a lot of silver linings on the economy, on inflation, on rates, on earnings. And so I want to talk through what is it that's driven so far a very different market performance this year versus what we saw last year. So Luke, thanks for driving the slides. If we flip to the next slide. So just to put compare and contrast just how different the performance has been so far this year versus last year. So last year, as Steve mentioned, it was such a tough environment for just about anything you looked at, whether it's the NASDAQ, long-term treasury, emerging markets, global bonds, everything was sort of down in unison. And the only things were really held up last year was oil, US dollar, and cash. Well, you flip that graph, almost the exact opposite right now, and you have the China stocks, emerging markets, long-term treasuries, Bitcoin that are all outperforming. And at the bottom of this chart, you have oil and they have the US dollar. So almost the exact mirror image of it. And we had to put together these slides a little bit ago, a couple of weeks ago. And what you see here, still positive performance, but I'll tell you, is much more positive today versus mid-January when we put some of these slides together. The NASDAQ, for example, is up almost 9% for the year. The semiconductor stocks are up almost 17% for the year. So it has been a spectacular rally. So the question is, what is it that the markets are responding to? Well, if we flip to the next slide, the markets seem to be looking through the first half of the year and really thinking about what's to come in the second half of the year, which is the end of central bank easing. So when we first came into the year, we were sort of, looking at the first half and saying, look, it might be challenging because you have slowing economic growth. And at the same time, the central banks, they're still trying to be hawkish and they're still trying to raise rates. But what the markets quickly did as we entered the year is they looked through and they saw that whatever challenges we had in 2022, there is likely light at the end of the tunnel, meaning the end of 9% inflation and also the end of the Fed that's hiking 75 basis points. So I want to spend some time on what are these silver linings. And let's go to the next slide. And here's the first one. Inflation is poised to slow down. We'll stay on this inflation slide. Thank you. And if you listen to the Fed Chair Powell's press conference yesterday, he said something really important, which is disinflation momentum has started. And he said it once, he said it twice, he probably said it 5 or 10 different times. And this is part of the reason why the markets were so optimistic. So what is this disinflation momentum that he's talking about? Well, take a look at the left-hand side, which shows you goods, services, and overall inflation. And that light green line is the fall that we're seeing in goods inflation. It is coming down fast. Year over year, goods inflation was running at 18% year over year last summer. It has now come down to, most recently, 3%. So whether it's food, whether it's fuel, whether it's durable goods, those prices have started to come down, and that's the disinflation that he's referring to. Now, if you look at the services inflation, that's the light blue line still on the left-hand side, services inflation is really not moving down all that much. It's sort of peaked, but it's not really crashing. And so you would think that maybe, that would be kind of a negative development. But again, Powell said something really important, that we suspect that too will start easing soon. And why is it? What is he referring to? Well, I think it's the chart on the right-hand side. The biggest component of services inflation, of course, is wages. And as we know, wage increases have been running at a really high level. But if you look at the chart on the right-hand side, you'll see that production and non-supervisory workers, the average hourly earnings were at some point growing at 6.5%. Well, that number today is coming down and it's now averaging 5% year over year. And I mean, anecdotally, this makes sense. If you have 50% of the layoffs that are happening in the tech industry, and if you have more and more companies outside the tech industry talk about layoffs, those amounts add up to something. And I think what they add up to is a little bit of a muted sentiment around the willingness to raise wages. So if you're a company, seeing the layoffs, you may be less willing to offer. You feel like you may not need to offer quite as big of a wage increase. And if you're an employee looking for a job and you're seeing these layoffs, you might have a similar sentiment and say, well, maybe I can't quite, be looking for quite as much of an increase. So that brings down the sentiment around wages. And I think over time will help moderate this wage inflation pressure as well. So that's one big silver lining, that inflation in many ways is starting to come down. Next slide. So of course, we know what the big deal is about inflation coming down because we all feel it day to day. But the big deal about it for the markets is that for the last, seems like forever, the Fed has been behind the curve. Inflation was rising and they were trying to raise rates, but they just couldn't do it fast enough. But if you take a look at this chart, something interesting happens in the middle of this year. And that is that light blue line is the Fed funds rate rises to 5%. We think that's where we stop. But the core PC inflation, another gauge of inflation, drops to 3.8%. So for the first time, there's actually a gap where the Fed funds are above the rate of inflation. And that's really important for the markets because it means it gives the Fed some leeway to at least pause rates around those levels, or if the economy requires it, they have slack, they have flexibility to cut rates if needed. So this, I would say, is a game changer, and that's what the markets are looking through. So that's the first silver lining, moderating inflation and this gap that opens up. The second one, let's go to the next slide, is this. The slowdown, the recession, the soft landing, whatever you want to call it. I actually think it's kind of all the same. The mild recession, soft landing, and a slowdown. Everyone's been waiting for this, but guess what? It's here. And I also think that it's largely priced in. There's a few reasons I say that. So what you're looking at on this chart represents quarterly GDP growth estimates. And as you can see, coming into, even in the middle of last year, the expectations for this year's growth were somewhere around 1.5%. Well, in the last several months, they have fallen dramatically. And now nobody expects the US economy to really grow this year. You can see that it's 0 to maybe slightly negative. So, that means economists have cut down their estimates. It means that companies have probably taken down their guidance. The analysts have penciled in lower earnings. And that's one of the ways to say that maybe, the expectations have been there and it has been there, and it's actually largely priced in. The other thing to say about this on the next slide, please, is it's not like we haven't been seeing a slowdown. This slowdown has been going on for quite some time. And you look on the right-hand side, you look at housing, that's been in deep freeze for, the last several months. You look at traffic of prospective buyers, for example, it's almost as low as it has been during COVID and before that in post the financial crisis. So housing has already been going through a recession. Tech layoffs have started. Manufacturing on the left-hand side has crashed significantly. So you look at the manufacturing activity index, if it's above 50, it's an expansion, and below it's a contraction. And if I update the numbers most recently, we have been in contraction territory, the reading of 46, 47. So we've seen the big correction. And, the perspective for investors here is you want to invest, not when the economic data is up here. You want to invest when you actually have depressed sentiment, depressed positioning, and depressed economic activity. And if I look at historical returns, if you invested when manufacturing this particular gauge was above 55, your average 6-month returns, forward-looking returns, would have been 2.5%. So not bad. But if you invested when this particular gauge was at 40 or was below 50, your 6-month forward-looking returns would have been 6.5%. So the slowdown has been underway. And now we're at a point to where it might actually pay to be a contrarian. And again, that's a silver lining that the markets are finding. Let's go to the next slide. And let's go further. One slide. One more. Here's another one. And this feels a little bit awkward to say because we don't want any, we don't want those around us and ourselves, to be laid off. But at the same time, this is what the companies have to do to preserve their profit margins. So my silver lining number 3 is that companies are doing what investors want them to do in order to reverse the margin pressure and potentially boost those margins once again. So what's the reason why it's the infotech companies and the communication service companies have been the one, and financials have been leading the layoffs? Well, if you look at the margins of these companies, they're the ones that have come down the most relative to all the other sectors. But once you cut back the costs, once you maybe reduce the payroll, you pare back the share buybacks, you reduce CapEx and take other cost-cutting measures. Once you right-size that cost structure, the profit margins actually have the opportunity to improve, and that's what the markets welcomed here as well. And my last silver lining here in the bottom line is, when you put it all together on the next slide, slowing inflation, growth slowdown that has been priced in, and the slower growth is not actually surprising the markets, companies that are trying to reverse the margin pressure. The fourth thing here is that the valuations have reset significantly. So as hard of a year as it was for 2022, it actually paved the way for a potentially better year in 2023. And so what this chart looks at is the valuations across the board, where we look at US equity, international equity, rates, credit, FX, and commodity. And if you look at the green square, that represents the valuation in the 1 year ago. So you can see that across the board, the valuation was expensive over to the right. Today, fast forward to today, and the blue diamond represents the valuation as it stands today, which has moved significantly to the left. And in certain cases, is as cheap as it has been in the last 15 years. Take bonds, for example, 2-year, 10-year, US, European bonds. As rates moved higher, those bonds have become as cheap as they have been in years. When it comes to the equity market too, you look at the S&P, you look at the NASDAQ, that blue diamond didn't move all the way to the left, but it has corrected quite a bit. And there's definitely pockets, there's definitely sectors that needed to correct, and they have done so as well. So as we think about this year, we think there's a very good likelihood that this is likely to be a better year. And given the reset that we've seen in these valuations, this would be the year to think about deploying capital into opportunities. So with that, let's talk about some of those opportunities on the next slide. I want to highlight kind of a variety of things here in the public markets and a little bit of private market flavor. But going back to the actual title of the presentation that I had, which is the luxury of being both defensive and opportunistic. What I shared so far probably came across somewhat optimistic, but I do want to say that we can't expect a straight line, returns from where we've been in January to the end of the year. So I do expect the volatility will still be with us. And we're not out of the woods when it comes to a growth slowdown. So it still makes sense to have some defensive positioning in your portfolio. And the luxury today is that we have an opportunity to do so. By looking at the cross asset yields here, it used to be the cash paid 0. Well, cash pays, this slide is a little bit dated now, cash pays 4.7% today after the Fed raised the Fed funds rate. So whether it's cash, whether it's municipal bonds, whether it's high yield, whether it's investment grade corporates, if you look at the cross asset yields on this page, there's a lot of ways to get paid while you wait out the economy, wait out the volatility in the equity markets. And that's not something that was available to investors last year, but it is today. The other side of this is we have the luxury of being defensive, but we also have the luxury of being opportunistic at once. And the fact that you can keep some of your money in cash and earn something allows you to methodically and deliberately deploy capital into opportunities when they arise. I probably wouldn't tell you that right this second is the time to jump into this market after the semiconductor stocks rallied and the NASDAQ rallied. But as we have a bit of a pullback, I think we want to have a plan in place where we start to dollar cost average back into this market. So what exactly do you dollar cost average into, and what are the opportunities? Let's go to the next slide. We'll talk first some public market opportunities here. I mentioned that valuations have corrected a lot, but they have corrected especially a lot in secular growth tech. If you look at the NASDAQ on the left-hand side, this is the multiple that was close to 35 times. It corrected to about 20 at the tail end of last year and sort of picked up to 23, 25 today. But nevertheless, we've wiped out this big frothy top that developed in late 2020 and 2021. And as a result, a lot of the secular growth stories are a lot more investable today. So over on the right-hand side, we look at some of the sectors that actually screen the cheapest relative to their 5-year averages. And it's energy, it's communication services, it's real estate, and infotech. So as I think about the opportunity set today, semiconductors, software, and real estate probably would be the top public market opportunities that I think about dollar cost averaging this year. Semiconductors, the reason why they had this sharp rally is because what better way to position for the end of the rate hiking cycle, the rebound in China demand, and then the eventual work down of the inventories that have accumulated. The best way to do that is actually through semiconductors. And by the way, that's one of the sectors that is the key enabling technology to all the other growth megatrends that are going up in the world, whether it's artificial intelligence, whether it's robotics or electric vehicles or smartphones. The key enabling technology for that is semiconductor content. And you need a lot more of it in an electric car, in an autonomous car, in a smartphone than you did in some of the other product predecessors. So you've got the secular growth tailwinds, and now you have a better cyclical opportunity in a sector whose valuation has reset quite a bit. So that's just one example of the opportunity that we're seeing in the public markets. And maybe I'll highlight one more actually, which is real estate. Real estate has been in the news quite a bit. And by the way, commercial real estate has been a great performer through the first half of last year. While the stocks and bonds part of the portfolio was down 60%, the private commercial real estate was up about 9%. Now, commercial real estate prices have started to come under pressure in the third and fourth quarter, but what's really come under pressure is the publicly traded REITs. They were down 30% last year, even though commercial real estate was down much less. But as a result, the reason why we had this sharp correction in publicly traded REITs is because it was all about rates. But if we are at a point where the Fed might actually be pausing in the next few months, and the valuation of REITs have corrected a lot, and they give you a 3.9% dividend income, and the implied cap rates on which they trade has gone from 4% to 6%, that's a lot of value that we're potentially finding in the public REIT sector right now. So those are the two types of opportunities that I would be highlighting in the public markets. Now, let me wrap up with just a couple of other thoughts and opportunities, pivoting to the private markets. As you could probably tell, I am a big fan of innovation. I'm a big fan of growth, and growth is not going away. We can go back one slide, please. But one other way to position for growth in some of the megatrends that I mentioned is through private equity. So look, if we go one slide prior to that, please, is to look at not just public equities, let's say leveraged to artificial intelligence, but also private. To give you a concrete example, if you think about investing in artificial intelligence, then in public markets, you're thinking about stocks like Microsoft and Google and Nvidia and others, and that's great. But there's 58 times more private companies that are actually leaders in AI or will be future leaders in AI. There's 58 times more of those available in private markets. So our big conviction is that if we are going to position for innovation, another way to do that is in private markets. So one of the other ideas for this year is to look at private equity and potentially parts of the venture capital structure, because much like in public markets, we say you want to invest when it feels terrible to do so, when valuations have reset. You want to do the same in private markets as well. And what you're looking at on this slide are the net returns depending on when you invested in a private equity vintage. So if you invested in the downturn vintage, which is the highlighted in gray periods here, if you allocated to private equity in 2001 through 2003, or 2007 through 2009, those returns, those dots, were higher than if you allocated just before that. So as we think about extending this chart, once we have the data, and we look at 2021 private equity vintage versus 2023, chances are the returns, if you invest in a 2023 private equity vintage, will be that much better because the valuation multiples will have reset. So we look at investing across the spectrum, public and private. So I wanted to bring that to your attention. But with that, I guess to go back to where I started, the market may not continue the trajectory of January, every single month and every single week. And in fact, I think we are due for a little bit of a pause, a little bit of a consolidation. But, if you ask me, will the market resilience that we've seen, does it have a chance to continue as we go through the year? I think the answer to that is yes, because a lot of the challenges that we had to deal with in 2022 are coming to sort of an end and a clearing and a resolution in 2023. And for that reason, given the recess that we've had, the markets can also have a better resolution as well. So with that, I'm going to pause there. I think that's about 20 minutes. So I would love to get your perspectives and take some questions.
Great. Anastasia, I'll keep your slides up as well if we want to reference the presentation again. But for everybody on the webinar, thank you so much for attending, and would love to open up a question and answer session here. So just a quick reminder, in Zoom, you're able to click the raise hand button in order to prompt a question. And while we're waiting for that, Anastasia, one big theme from 2022 was supply chain, right? Goods versus services that you called out within that inflation chart. What's the latest on supply chain? We hear a lot about, deglobalization. What are your thoughts kind of moving forward on supply chain within this global world, so interconnected, but we found out that supply chains are actually a little more fragile than we expected them to be when we turned the economy off and reopened. So some thoughts on supply chain management and inventory levels right now would be a great place to start. And then we'll let other questions get queued up as well. Thank you.
Yeah, sounds good. Well, clearly, a lot of what's driven the durable goods prices higher have been the supply chain challenges and lack of inventories. But if I look at the charts today, once again, they're the exact opposite of what we saw in 2021 and 2022. So, for example, we track this index, this supply chain bottleneck index, which would include things like port closures and how long does it take, for the ship to arrive and for the ship to be unloaded. We track things like the dry bulk index and, how much does it actually cost to transport things. And when you put together all those measures, the peak bottleneck time that we have seen was at some point in 2022, in the middle of 2022. But since then, that bottleneck index has come down significantly, and we don't actually have the same supply chain bottleneck as we've had before. So we've sort of cleared that. And as a result of that, you are seeing this big easing in good CPI. And in fact, you're now seeing a month-over-month decline in those good prices. So that's one thing. But inventories also have a lot to do with the equation. The reason why you had a supply chain bottleneck issue is because we can get enough, fridges and microwaves and washing machines and everything that we needed during the pandemic. And as a result, the retailers have over-ordered. They ordered so much, they hoarded the inventory just at the exact wrong time when the demand for durable goods has started to come down. So as a result, if you recall earlier last year, Target, Walmart, other retailers have been stuck with inventory that they didn't actually need. So they're working down those inventories, but that in turn affects the shipping sector as well. The reason why we've seen the easing in shipping conditions is because there's not this inventory accumulation and inventory chasing that we saw last year, and therefore you don't have the bottleneck condition in the shipping sector. So I would say, Luke, and I think Mike, thank you for your question here, that a lot of those conditions have been cleared. And I don't want to say that was the easy part, but maybe that was in fact the transitory part. The jury is still out whether the service inflation and the wage inflation is transitory or not. Maybe I'll share one last thing on the bottlenecks as well. But I think, Luke, you mentioned this. I think it has sort of taught us a lesson that we do need to build supply chain resiliency into the system. And, those supply chains need to be closer to home. And we may need to bottle up or double up rather. So as a result, I do think this is going to be a secular shift to bring some of the supply chains, back locally or at least regionally. And that's a trend that's going to likely be with us for a while.
Great.
By the way, bodes well for real estate, especially things like warehousing and logistics.
Well, actually, and I think that's a good segue just to talk a little bit about the housing market. A lot of our clients are across the country. We're located here in Southern California, you there on the East Coast. We've seen a rampant increase in our house prices and just very, very limited supply. So in some cases, when looking at, are we in a recession, that soft landing conversation, it seems as though different parts of the market are impacted differently, and housing is blinking red from a recession perspective, looking at the impact of rising interest rates, and it just seems like there's not much movement there. So any thoughts on real estate and house prices and that balance of interest rates and locking in a new 30-year mortgage?
Yeah, look, housing is in a recession, and housing probably has been in a recession for the last number of quarters. But there's, those are some of the reason I say that, I showed that index of prospective traffic, which has been the worst since COVID. If you look at the median home price, it has been correcting lower for the last 6 months. So that's actually good news. I recently saw a chart that showed the cancellation rate on contracts, and it's something like 65%. I mean, it's just astronomically high. I think it was for one of the home builders. So housing is already going through a very tough patch because, let's face it, 30-year mortgage rates at one point reached 7%. So we've sort of been in, dire straits, but at the same time, I do think the outlook for housing improves somewhat over the coming quarters. First of all, I think the 10-year Treasury yield has peaked. Meaning we got to 4.4%. We're now at 3.4% on a 10-year Treasury. And that's, of course, the big driver of the 30-year mortgage rate. So as rates stay more anchored around this level, the long-term rates of 3.4%, I think that's going to take a little bit of pressure off the housing market. And now that we have seen a correction lower in prices, I think some buyers will be looking back to the market and looking for deals. But I don't expect that the home prices will see, the degree of correction we saw during the financial crisis, for example, because you're right, inventories are extremely tight. If I look at multifamily residential apartments, vacancy rate is something like 4%. If I look at vacancy rates in single family homes, it's like 2%. So over the last number of years, we had significantly underbuilt those residential units. And that's why, as challenging as the rate environment is, people still need to move, and there's limited places of where they can do that. So I think we'll continue to see some downward price pressure in housing and apartments, but maybe it's an 8% correction from here versus a 20%.
Great.
So, but I would probably be more optimistic on housing at this point as this correction plays out. And, I don't know about you, but, we're probably, all of us or some of us are on the lookout for, rates to kind of start pulling back and home prices to pull back enough, to see if there's some deals to be found in the housing market.
That's the real estate soft landing, I suppose.
Right.
It looks like we've got a question from John here, and just another quick plug. To ask a question, you press the raise hand button at the bottom of the screen. John, I'm going to go ahead and ask you to unmute your line, and then you can ask Anastasia a question.
I guess to your question of what's making China grow this year, and why do they have 4 or 5% growth rate? Well, the first thing comes down to just the potential GDP growth, right? And potential GDP growth in China should be higher than the U.S. given the population growth and given productivity growth. But obviously, the big reversal in China this year is the COVID reopening. And I think that's going to unleash a very powerful rebound in consumption. To me, from a market perspective, when 15 or 16% of the world GDP says they're going to open up the economy and go from, I think, virtually no growth to 4 or 5% this year, that has implications. So to kind of go back to, how does this link back to the US? Well, I don't necessarily think that we're going to see another surge in goods inflation, because people who have been locked up in China, they're not going to be going out and buying refrigerators and microwaves. They're going to be traveling. So the consumption rebound that we expect in China is related to travel, related to mobility, maybe, purchasing, items that you would purchase once you actually start going out. So it is much more likely to be a domestic rebound in service consumption that shouldn't spill over into kind of inflationary pressures elsewhere, except for one channel, which is energy, which is oil. If all of a sudden China goes from consuming 15.5 million barrels a day, as they've been doing, during the zero COVID policy, and if they rebound to 16.5 million barrels, which is what they were doing before COVID, that could be once again an inflationary factor for oil prices. So that sort of will beg a question, do energy prices start rising again? Does that feed into some of the durable goods? Does inflation actually start to pick back up again around the middle of this year? So I think it's too early to tell, but I didn't talk much about energy, but that's why I would continue to have energy exposure in the portfolio, because if China rebounds, mobility there rebounds, oil is likely to continue to tighten. The balances continue to tighten, and higher oil prices should support energy equities. So that's kind of how I think about the China reopening. And of course, semiconductors also are big beneficiaries of positive momentum there.
Thank you.
Thanks for the question.
Right. Yeah, I think on that point, we saw the big divergence in the goods versus services. When everybody was locked up, it was building a home office and home renovation and the real estate market going crazy. And that gave way to more traveling, services, eating out. And that sounds like that inflation's been stickier as well, Anastasia. We haven't quite seen that turnover, but things are getting a little bit tighter. Quick question here about the stimulus we saw be pumped in, not just domestically, but globally, trillions and trillions of dollars were pumped in with very supportive policy to spur economic growth. So can you talk a little bit about the relationship between the stimulus we saw here and inflation, and has that run its course? And maybe as a final part of that question, with all of the aggressive interest rate hikes we've seen, from what I've read, it might take 6, 9, 12 months for the impact of those risen rates and this new interest rate environment to really have the impact of cooling the economy and reining things in. So hopefully that all ties together within that stimulus, interest rates, and kind of how much progress have we made. Sounds like a lot in some areas, but if you talk about that, that'd be great.
Yeah, absolutely. Well, the COVID stimulus has run its course, but I guess it's taken longer than maybe people would have expected. First of all, as you said, it was a tremendous amount of fiscal stimulus that was pumped into the system that was still fueling the economy early in 2022. But as 2022, kind of went on, we went from fiscal stimulus to fiscal drag. And that was actually already starting to drag on economic growth. But the reason why you didn't feel it, and the reason why the consumer did not necessarily slow down, is because the consumers were drawing down on their personal savings. And so personal savings rates has surged at some point to double digits. And if you look at the personal savings rate now, it's probably as low as it has been in a number of years. So the reason why consumption is not slowed is because people were leveraging the personal savings that have accumulated during the pandemic and due to fiscal stimulus. So that is something that the Fed also looks at. And, this is why they probably feel a little bit less pressure to raise rates this year, is because they know that savings have run down, fiscal stimulus has run out, so they shouldn't be this additional boost that's going through the economy. But a good friend of mine is actually economics professor, John Hopkins, and he did this study that was that he published and presented at Jackson Hole, the big gathering of economists and central bankers. And he found that the bulk of the inflation surge has actually been driven by fiscal stimulus. And so the fact that it has started to run off should actually ease some of that pressure going forward. But it doesn't, I guess, resolve the structural challenges, like the fact that we still have 1.8 job openings per every unemployed person. That's not a matter of fiscal stimulus. That's a matter of people have exceedingly retired during COVID. And, so there is a supply demand for labor mismatch. But fiscal stimulus, I would say, has run its course.
Awesome. We've got time for one more question as we wrap things up. Going once. Going twice. Anastasia, I think final thoughts. I think you called out, we've seen maybe somewhat of a surprise to open the year. And I think there was so much pessimism at the end of last year that it's a good reminder for all of us that the economy doesn't necessarily have to be good or bad. It's not that black and white, but it's more of a spectrum of, are things improving or are things, worsening? And it looks as though the start of the year, things are less bad given how pessimistic we were early on. So what keeps you up at night with where we are right now? You called for somewhat of a consolidation right now, but just to kind of introduce more patience, what keeps you up at night? And we'll close it with that.
Yeah, that's like a sobering note to close on, but I'm just kidding.
We'll bring some optimism at the end.
Okay, great. Well, it's a good question. And so look, first of all, it does kind of worry me here how far and fast we've run here. This is just from a pure technical standpoint. You look at kind of the trading levels of tech stocks and semiconductors, and you heard me make a positive case for them, but they've gone up very like a lot in a short period of time. So, to the point where some of the technical factors of screening overbought. I don't know if that keeps me up at night. I just think it's the nature of the markets, and you get ahead of yourself and you have a bit of a consolidation. But what really probably is in the back of my mind is that everybody upgraded is European growth because natural gas prices have absolutely collapsed, and China started to reopen. But the biggest risk to Europe is actually what happens to their domestic housing market, given that most of their loans, residential mortgage loans, are floating rate securities. So in the US, only 4 or 5% of mortgages are floating rate. But if you look at the UK, if you look at Spain, if you look at Portugal, some of those percentages are something like 70, 80, 90% of their mortgages are floating rate. So all of a sudden, the consumer might feel a little bit of relief from lower electricity bills, but you could have a very significant rise in mortgage expense for a typical household in Spain, for example. And I don't feel like consensus is talking about this. And if you look at the ECB transparency report or financial stability report, they specifically call out for an X% increase in rates. They expect an X% decrease in home prices. And I don't know that that's widely being considered as economists sort of pencil in better growth for Europe. So that's probably the biggest risk that I would say. And, there's going to be pockets of pain in the US markets. Maybe it's companies that have a lot of floating rate exposure. Maybe they'll feel it, but those are pockets. But when you start talking about something like the housing market, that's not a pocket. That's a large chunk of the economy.
Great. Well, Anastasia, thank you so much for the work that you do on a daily basis to help inform us and all the other advisors who are partners with you there at iCapital. And for our clients, Anastasia is frequently on CNBC and other network programs. So be sure to keep your eyes out for that. Steve, I'll give you the final word so we can end on an optimistic note to play the other side of that coin. But thanks to all for joining us and wishing everybody a great start to 2023.
Well, thank you, Luke, and Anastasia, thank you for your insight. And investing is about long-term. It's about patience. It's about volatility. And this is my 40th year in business working with real humans, and we all have emotions. So when Anastasia's mom asked her, honey, what's really going on and should I be worried? And it's all about allocating assets for the risk of who you are. So we really are very intentional here at our firm working with our clients on an individual basis. It's not one size fits all. Everybody has unique needs in their financial planning. And it's important that we communicate. This is a partnership, as I deeply believe. So in communicating with your advisors, be it Brian, David, Luke, or myself, that's what it's all about. We navigate, we consult with very wise people. There's sometimes we just need to work things through, but we're still coming out of all this COVID craziness, and it's going to take a time to work through. Things are looking less dark than they were, but there's still pockets of booby traps. So we're still being very cautious in our portfolios, and to kind of like close where she started, there's, reasons and room to be defensive, and there's definitely opportunistic moves there too. So things will look a lot different as these next quarters, come about, and just stay in touch. And it's going to be an interesting year, but thank you again. Have a great evening. And thank you for your trust and your partnership over these many, many years, and have a great February.
Great.
Thanks, everybody. Take care.